Markets like today often cause investors to ask, are we at a top? Is this a bubble? Should I change my strategy? Should I go to cash? And so we have an entire slide deck that we affectionately call Why Stay Invested. And it's a series of illustrations that help hopefully to make the point to you that finding a plan that fits your risk tolerance and sticking with it is the right course of action, or at least history would tell you as much. First chart here is the growth of $10,000. So this is if you put $10,000 in the S&P 500, 12/31/1979, and then you just went to sleep. You didn't put money in, you didn't take money out, you just reinvested your dividends and let it grow. You see on the left there, the total period, you'd have almost $2 million from that original $10,000 investment. Missing just the best 5 days, the next bar over, costs you over $700,000. Missing the next 5, getting to the top 10, another $300,000 plus, to the point to where if you miss, the best 30 days in general, $300,000 versus almost $2 million. So the difference in that compounding is significant and massive. And so we're often asked, when were those days? Are they all together? Are they different? Are they separated? So we've laid them out here for you on the slide. Pause it if you'd like to go into the detail on the dates. I'm not going to do that for you here. We think the next page is more helpful to discuss. But basically what you're seeing on the slide, top 10 days on the left, bottom 10 days next, and then the next 10 down and up days on the right. So basically covering the top 20 days since 1979. So that's what's on the chart. This next slide we think is much more interesting, which is the point of how often are those top and bottom days near each other. So we looked at a period of 10 days. So is the top 5 and the bottom 5, were they within 10 days of each other? And you see that in black, 60% of the time they were. You move out to the top 10 best and worst days, 80% of the time they're within 10 days of each other, and then 77 on the top 30. So what it tells you is they often happen together. So we'll see a big decline, a big bounce back, or a huge run up and a fall back there. We often don't know the order that they're coming in, but they are more than likely or have historically been pretty close together in time. So it makes it really hard to choose and to time your market. Next slide here, we'll look at the probability of positive returns. And so you see periods from every day, which is kind of a coin flip, out to 3, 5, and 10-year periods where you're getting into the 80, 90% of the time you're going to see a positive return over that period, or you have historically. So we go all the way back to 1926 here. You'll see other examples that maybe start at the end of the Great Depression or the end of World War II. The pattern is exactly the same. Honestly, the numbers get better when you do that because you drop out the 1930s, which had a lot of really difficult, challenging returns. The rest of kind of market history hasn't been that extreme. But the pattern's the same, the message is the same. The longer you're willing to stay invested, the better probability you have, again, historically, of having a positive outcome. This next page takes a little bit of explaining, so stick with me for a second here. What you're looking at in black are the ending price returns year by year for the S&P since 1980. Blue, hanging down, is the lowest point the index hit at any period of time. So if we start January 1 at 0, a blue bar heading down means it declined at some point. But as you see in most of those periods, the market still ended positive. So the banner tells you 76% of those price returns since 1980 were positive. However, at the one at the bottom tells you 93% of those years saw a loss at some point. So there were times when if we just tapped out because the market was down, we missed out on a gain for the year, or even that biggest negative blue bar was 2008. The market finished higher than that lowest point. So if we tapped out at that bottom end, we missed 10, 15% back that the market recovered before the end of the year. So very common period. Lots of times for us to kind of experience that. However, our next chart shows you, really the preponderance, again, of returns are positive. So zoom out. You're welcome to pause and look at specifics if you want, but let your eyes zoom out and just look at the size of the stacks. So black bars headed up and to the right are positive years. Blue bars headed down and to the left are negative years. Your eyes just tell you there's a whole lot more black bars, right? Almost 3/4 of the time. But you also look at that little tiny note beside. The average return in those positive years was 21%. If you look to the bottom, the average return in the negative years, 14%. And again, your eyes even show you this. As you move further from center, the returns get larger. So all the way out to the right, 30+% years for the S&P, it's a pretty big stack. But then go all the way out to the left, negative 30% or worse years, it's only 3 of them, including the 30s, including 2008. So, often we talk about, when's that cataclysmic bear market going to come? And they happen. They just don't happen that often, and certainly much less often than the good years. So percent of years the index falls by various measures, and really this is one of those points of how hard do we make it on ourselves? So how often are we going to experience these negative returns that make us want to do something, or are we planning for something that just doesn't happen that often? So you see 3 different color bars. Black is the NASDAQ representing growth, blue is the S&P representing core, even though it leans a little growth these days, and gray is value, Russell 1000 value. And so you see, which makes sense, there are less kind of negative or bigger declines as you get more conservative in your strategy. But you also see it happens fairly often. So far left, down 10% or more, about 1 out of 3 years, regardless of which benchmark you're using. 15% or more, kind of 1 out of 5 to 6. 20% or more, 1 out of 10, 1 out of 8. So again, on the left, we're going to see declines pretty frequently, 1 out of 3 years, 10% or more. And to some people, that's uncomfortable. So again, we're trying to set expectations. But if we're going back to the far right, big down years, 25 plus, it just doesn't happen that often. Kind of 9 out of 10 years on average have been positive for these indices. This goes back to 1979, so we have a common period. Again, if you bounce back to kind of the post-World War II for the S&P, the numbers are pretty similar, a little bit higher, but pretty similar. The pattern remains the same. So 2 more charts for you here. We call this one quilting. So for those of you that had something that looked like this on your grandmother's bed, maybe just lots of patches in different colors. So again, I'd ask you to zoom out and just look at how the colors kind of bounce around on the page. So each column is a year, and you see the colors move all over the place. You will notice that white box in the middle that largely stays in the center of the chart. That's a 60-40 portfolio, 60% stocks, 40% bonds. So that's your kind of measure of, or an illustration of diversification, that it helps you avoid the highs and the lows. So you hear that a lot when we talk about asset allocation. How do we help smooth the ride out, which is really our next chart here. We title it, choosing your ride. And again, I just ask you to zoom out. And the line I tell you to focus on is that real bright blue one, and that's 100% stocks. So you see it going up the most during various periods. You also see it falling the most. Over this full time period, it has gained the most, but it's done so with the most volatility, the most movement in its price. So there's some people that love roller coasters, right? They enjoy the ride, they're comfortable on it. It doesn't bother them to see the ups and the downs. There's others that about halfway through are ready to get off and are nauseated and said, I'm done. And so it's really incumbent upon us as advisors and you as a client to meet together to figure out where that line is. So where can we set a goal for you that helps you meet your financial goals, but doesn't make you sick in the process, right? That's no fun. But really, I'm joking, that doesn't make you want to make a change at the wrong time, because that is what the end result is. Can we keep you invested through these crazy ups and downs so that at the end of the day, you meet your goal? That's our job, and it's our job to help you do that. So thank you for taking some time with us today.